There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. We're not at that level. Clearly today, we've just moved, I think, probably into the very lowest level of what might be restrictive. Certainly, in my view and in the view of the committee, there's a ways to go.
I don't think he would say that he's completely given up the idea that we could get out of this with at least something that's softish. They said the unemployment rate is only going to be 4.4%. I think that's still much too sanguine. I think it's probably going to go beyond 5%. So I think they're being a little cautious now in making their forecasts.
I think the dots are conveying the determination of the committee under Chair Powell's leadership to move policy into what they think of as a restrictive territory. The economic forecasts are obviously dependent also not just on policy, but a lot of other factors. But I do put a lot of weight on what the dots are trying to tell us right now.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. More anguish ahead. The Fed hikes 75 basis points as Jay Powell signals a recession may be the price to pay for crushing rampant prices. Stocks swoon and yields jump. The Bank of Japan holds rates as the yen hits the weakest level in 24 years. Russia tensions add to the risk-off mood. Up next, the Bank of England. Bailey & Co. are set to deliver another half-point increase, the first back-to-back jumbo hike in 30 years. It is an insanely busy day with rate decisions from central banks. We're just getting Deutsche Bank coming through, doing as expected, hiking 50 basis points. That means that their policy rate now stands at 2.25%. Recall the Norwegian central bank was one of the first to really start the rate hike cycle. So the pressure on them is less than others. But you can see the krone weakening at the moment versus the euro. This is the world we live in, where a 50 basis point hike is not enough to stem declines in currencies, considering the pressure that Powell and company has put on delivering big rate hikes and how that tightens financial conditions for everybody else. We also had something extremely similar when it came from the S&B as well. They also moved their policy rate above zero for the first time in almost 8 years, yet we saw a Swissy that is weakening. What you're looking at now is Central Bank Governor Thomas Jordan, at the S&B. We don't have English translations for you, so currently don't have exactly what he's saying. We'll monitor those headlines. But again, at the moment, what they are facing is other central banks, be it Riksbank that went 100 basis points, the Fed, which went 75. That means that what they're doing looks small in comparison. They did say, the S&B did say it can't rule out more interest rate hikes in the foreseeable future, but it is worth noting that by hiking their policy above zero for the first time in almost 8 years, this ends negative policy rates in Europe. So this is quite the consequential decision just from this big picture historical view. And of course, we're going to be speaking with S&B Governor Thomas Jordan and the Deutsche Bank Governor Ida Woltenbacher later in programming as well. So stay tuned for those. And of course, we'll keep you up to date on the moves. I also want to bring you some Deutsche Bank lines because we're also looking at Deutsche Bank share prices moving higher. Some positive noise coming from CFO James von Moltke, who says he sees this year's revenue, 2022, at the high end of the guided range. So you are looking at a Deutsche Bank at the moment. This is the year to date. It is fallen. It is hurting. But this is something that might boost it. Also, von Moltke saying that they've taken some hit on leveraged loans. This is a problem we've been seeing throughout the liquid bond market. It is essentially seized up. Banks are pulling back. We will be talking to Silicon Valley Bank UK. So that will be interesting, again, to get their view. But I should just note we're looking at Deutsche Bank shares just pushing into the positive for today, up 0.6%. They're also saying as well, again, that 22 revenue, it'll be at the high end of the guided range. We're also seeing strong FIC performance in the third quarter. They're saying that there's some momentum in the private bank, in the corporate bank, some weakness in origination and advisory. Again, that has to do with deals slowing down, but also at the same time, no appetite for equities to return. That is, again, the risk environment we live in. Loans are seizing up. Equity deals are seizing up. But the whole picture of Deutsche Bank is a positive one because of the revenue coming in higher. So let me show you what the intraday looks like. Again, for Deutsche Bank, it started out the day negative, just moving into the green after these lines from Von Moltke. At the moment, Deutsche Bank is up 0.7%. So let me get your view on the overall market so far this morning, because it is one of fleeing risk. It is one of continued digestion of Jay Powell saying that they will do what it takes. They will keep at it until the job is done, with echoes of Volcker in that. You're looking at S&P 500 futures, which have actually turned positive, up 0.3%, despite falling into the close yesterday, down 1.7% yesterday, closing at more than 20% drop from the January high. Still, even so, you are looking at a 2-year yield, which is moving higher by about 4.5 basis points. It is ever so slightly off the highs of today. At one point, it was at 4.1%, but still, that is a 2-year yield that is at its highest since 2007. It also means we're looking at a yield curve that is its most inverted since 2000. Euro, that's also moving more positive, but still, one thing that's not succeeding in getting any traction versus the dollar is the yen. At one point, is at 145. So yes, risk might be turning in the U.S. It is helping ever so slightly to lift European equities as well. We're down now just 0.6% on the benchmark. You can see it differs region by region. Banks are turning. It's helped in part by Deutsche Bank. We had some Unicredit news as well. So banks, one of the better performing sectors, but most sectors falling today. Again, it's the concern about risk. If we are getting global tightening, and tightening really reinforced by the Fed, do you want to be buying risk assets, especially given that lag in central bank policy? It might be some time before we truly understand the hit to corporate earnings it will take. So let's dig more into the Fed, of course, raising rates by 75 basis points and signaling even more aggressive hikes ahead than investors had expected. Jerome Powell warned that it's going to hurt, admitting that the chances of a soft landing are diminished. However, the FOMC remains committed to achieving its inflation target.
We have got to get inflation behind us. I wish there were a painless way to do that. There isn't.
Let's get straight to George Saravelos, head of FX strategy at Deutsche Bank, and one of the leading voices in trying to help us understand this environment of higher dollar over everything. George, I know you wrote last week that essentially the dollar play, the strong dollar play, is one where it's the only haven, it's the only harbor in this volatile world. But does an aggressive central bank, does an aggressive Fed that raises its dots to 4.6% average for next year put rates back in the driving seat?
Good morning, Danny. And I think the point you made earlier in the show about all these other central banks hiking rates, the Riksbank going 100 basis points, the SMB 75, Norway 50, and yet all the currencies weakening, I think that goes to the crux of what is going on in the market this year. The tightening we're seeing is relatively symmetric. If you look at interest rate differentials, they're not moving especially aggressively against the dollar, but the dollar is still making these huge gains this year. And I think it's all about the safe haven dynamic, where effectively dollar cash has proven the only hedge that has held its value, so to speak, for any international investor. So what we're seeing in the data is investors are selling US assets. For example, the Japanese are selling US bonds, but the big difference versus history is it's not being repatriated back into Japan. People are selling US assets, but they're keeping those proceeds in dollar cash. And I think that's the key driver behind dollar strength this year, this risk aversion.
Well, since you harken back to what I started saying on the show, I got to go back there because I do find this really interesting. You have the S&B hiking 50 basis points. It's expected. Swissy gets clobbered. I think it's down about 1% versus the euro and the dollar. You had the BOJ do again, as expected, hold rates. I mean, at this point, George, is there anything that these central banks outside of the Fed, anything that they can do to actually deliver something which can help elevate their currency in the face of a central bank that's resolved in hiking rates?
Well, there is. They can be hawkish. They can start talking about the importance of the currency. And for example, that's what the ECB has been doing. So it doesn't prevent the euro from weakening, but it prevents disorderly moves. And you can see European real rates have been rising. some of these outflows from Europe that have been on the back of negative rates have stopped. So the euro is dropping, but it's dropping by less. Now, if you take Japan at the other extreme, there's not even an attempt to do that. In fact, I would argue the Bank of Japan is pursuing a purposeful policy of active yen derating, even though they're not admitting it. They're following essentially the policy advice of Ben Bernanke. He wrote this paper a few decades ago where he said, if you want to get inflation up in Japan, the only way to do so is to derate your currency. And that's what the Bank of Japan is doing, and the market is essentially following. The yen is down nearly twice as much as every other currency because the Bank of Japan is not supporting it. So it really depends on how willing and proactive a central bank is going to be. And that's why the Bank of England today, for example, is going to be very critical for the pound.
Yeah, George, we'll get into Bank of England in just a moment, so hold those thoughts. But when it comes to the yen, for those who are watching, taking sort of every bit of verbal intervention from BOJ, from all the policy officials there at potential intervention and hoping for that, are they just wrong-headed right now? Is it folly to believe that there will be any unilateral or more coordinated intervention in the yen?
So I'd make a few points. The first one is we had government officials come out right after the Bank of Japan meeting today saying they are supportive of the Bank of Japan's policy in terms of raising the price target. That is an implicit support of what the Bank of Japan is doing, and also an implicit recognition that essentially intervening to bring down dollar yen would go counter to the policy objective. So I think the odds of intervention are relatively low. We've had a lot of verbal intervention to try and prevent some one-way moves. But even if we do get that, it's highly unlikely it's going to be effective. Number one, because it's not going to be coordinated. It's very unlikely the US participates in an intervention to strengthen the currency, which its own central bank is actively derating. Plus, on the Japanese side, if you think about the mechanics, it would involve selling dollar reserves, selling US treasuries, which would then lead to higher US yields, which would push dollar yen higher as the Bank of Japan is injecting liquidity. So it's simply not credible.
Hey, George, I just want to squeeze in one last dollar question before we go to break. Of course, you're sticking around with us, but I quickly want to get this in. You've written about this idea that the dollar's overshooting, valuation anchors are being challenged. But George, why should I care about what history tells me about the dollar in a world where we're witnessing a regime change and, as you put it, this geopolitical strife that's driving us to the dollar?
I think that's a great question, and it goes to the point that if you look at the dollar historically, it's clearly overvalued. But the loss of these valuation anchors because of historic events, the Bank of Japan balance sheet expansion is historic, the European energy crisis is historic. It makes it very difficult to calibrate and understand what fair value is at the moment. So the market is being driven by these safe haven effects, and I think you need to see a turn, for example, in the European energy risk premium or from the Bank of Japan to start even thinking about a turn in the dollar.
Yeah, and George, I got to say, people clearly not listening to you. As we've been speaking, we're looking at the yen absolutely go gangbusters against the dollar. It's now positive on the day versus the dollar, or at least unchanged. We're going to get Conda from the MOF speaking soon, so perhaps some people speculating intervention in the yen. All right, George, stick with us. Much more to cover. George Saravelos there, Global Head of FX Strategy at Deutsche Bank. Coming up, it's also BOE Day. We're going to preview the UK's central bank rate decision as pressure mounts to clamp down on inflation. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. Some breaking lines coming through. Bank of Japan, MOF's Conda saying they have intervened in FX markets, saying we have taken bold actions FX moves have been sudden, one stop. Again, we don't know exactly what form the intervention has taken, but Conda's saying that they have intervened in markets. We are seeing a remarkable turnaround in the dollar yen. It was down more than 1%, the yen versus the dollar at 1 point today. Now dollar yen is down about 1/3 of 1%. Again, Conda from the MOF in Japan saying that they have intervened in the FX market, saying that they will monitor with high sense of urgency, again, saying that they have taken bold action in markets. Let's get back to George Saravelos, head of FX strategy at Deutsche Bank. George, what are your first take on these lines coming from Conda?
So I think it's clearly giving a signal that they're becoming a bit uncomfortable with how quickly things are moving. And as you mentioned, overnight, there were huge moves in dollar yen. But at the end of the day, I'm not convinced this is going to be effective. The first reason is it's not coordinated. You're not seeing a participation from the side of the US. And historically, it's only coordinated interventions that have proven more powerful. But the second and most crucial point is that then this is leading to contradictory policy within Japan. You have the central bank on the one side easing policy, injecting liquidity into the system, and the Ministry of Finance on the other side trying to remove liquidity and strengthen the yen. That's a policy inconsistency. I think as they're selling reserves, for example, you will then see the market think about the transmission channel, which is selling reserves implies selling US treasuries and higher US yields, which push dollar yen higher. The point is there's a lot of internal contradiction here, and they will have to do very large amounts to have any sort of impact, which I suspect over time will be more limited once the initial positioning gets flushed out.
I mean, I do have to wonder what the top currency official, Masato Konda, is speaking about here, because he says that they've taken bold action, that they've intervened. Earlier, he was talking about this idea of stealth intervention. George, you say it's not enough if it's just unilateral, but what sort of intervention do you actually expect that this has taken the shape of? What can they do at this point, again, without getting sort of coordinated intervention from the U.S., a G2 intervention?
Well, I think we're going to find out over the next few days in terms of the amounts. They're going to be officially released in a few weeks in terms of the size, and the market will take a guess. But again, the only thing that can be done is directly intervene in the spot market. It essentially implies selling some of their dollar reserves. They are large, it's around $1 trillion, but they would be selling into a policy combination for Japan that's still set up for yen weakness. So I'm not convinced it would be an efficient use of reserves or have a long-lasting impact.
But George, why talk about this at all? Why try to jawbone? Why try to do this type of intervention? Again, as you say, because the Bank of Japan can afford to have the inflation come in that a weaker currency affords them.
So the objective would be to just reduce and create some more two-way moves in the yen, reduce some of the long dollar yen speculative positioning that has been out there. So essentially just try and slow down the move. And I guess try and gain a bit of credibility given that they have been talking about it for almost 3 months now.
Yeah. And so at the point, just to keep everyone updated again, we heard from the MOF's Konda talking about that they have intervened. We are looking at a yen that started out the day weaker after a BOJ decision that kept rates unchanged. At the moment, we are now looking at a stronger yen versus the dollar. It's gaining about 0.8% versus the dollar. It's trading at 142.93. Konda also saying the government is highly concerned about excessive moves. So, George, this goes to your point. It's about the pace of moves that is unsatisfactory to them. So if it's about the pace, George, and not necessarily the level, what is a level, or is there a level that we could more seriously consider the idea of G2 intervention?
I think we're still quite far away from that. And the reason is, if you think about US policy at the moment, the predominant objective of the Fed is to lower inflation. And one way of achieving that is via a stronger dollar. So to have the US intervene to weaken the dollar at the same time would be highly contradictory and would be undermining the Fed's objective function. If you look at the European side, again, to satisfy some of those conditions for intervention that are set out in the G20 finance minister statement, you need disorderly, highly volatile moves, which are not taking place. If you take a look at the euro, it is weakening, but it's fairly orderly without strong volatility. And at the same time, you have this deterioration in underlying fundamentals. So I think the bar for coordinated intervention in the manner of the Plaza Accord, for example, is still very, very high, and we're still quite some distance from that. And the fact that the Japanese are now intervening, but unilaterally, I think speaks to that point.
Yeah, fair enough. And we are continuing to see strength in the yen. Now it's dollar yen is down by about 1.1%, George. So do these gains, are you saying essentially that they're not sticking around, that this is just a gut punch reaction?
I would suspect that once the market has adjusted some of its positioning, it's unlikely these gains are sustained. And the key driver behind ultimately turning dollar yen will have to be the Bank of Japan shifting policy, as well as, of course, the Fed.
So our anchor out of Hong Kong, David Ingles, just lets me know, George, that this is the first time that they've intervened to prop up the currency since the late 1990s. So we've talked about it on the side of Japan, why they might not want a more coordinated intervention. They just want to, again, stem some of the declines, verbal intervention, what be it. But it's not just Japan, of course, George, that's struggling with it. We've been talking about it for the past 20 minutes. This is a problem throughout the globe of a stronger dollar. But from the angle of the Fed, from the angle of the U.S., is there a point at which they would want to intervene? Because for them, of course, it helps to have the strong dollar to try to combat some of the inflationary pressures.
The short answer is no. I don't think the Fed would intervene. Of course, it would be on behalf of the Treasury because it's the Treasury's remit. But when you have Powell come out in the evening and say bringing down inflation is priority number one, it's simply not consistent with policy to try to weaken the dollar at the same time. The other point to make is that if you look at previous periods of dollar strength, historically, they've been associated with some source of financial or systemic instability, especially in emerging markets. But over the last 10 years, the world has deleveraged in terms of foreign borrowing in dollars. So even though we are seeing dollar strength, it's not a big source of financial stability risks, which would be one reason, for example, behind coordinated intervention.
So we are seeing some of the gains in the yen already start to back off, still stronger versus the dollar, 0.8%. George, can I put it in really stark terms? Have Japanese authorities lost their credibility with the Forex community?
I think what the market will be looking at over the next few days is the size of intervention, trying to back out how much was done. That will eventually be published. And it will be assessing how many sales of dollars did it take to create this move. And if that number is very high, the market will conclude that it really has a very high cost to try and push dollar yen lower. But my initial conclusion still stands. If you've got a central bank that's still essentially providing yen liquidity into the market, that's doing very large amounts of QE, intervening at the same time is very unlikely to work.
All right, George, I mean, a lot of drama going on with the yen, but I do just want to take a quick pause from that and move on to the BOE. I need to squeeze this in here because, of course, it's just a few hours to go until we get a decision from the BOE. George, what is it going to take in terms of them, just in a minute here, what is it going to take in terms of hikes for you to abandon your short on sterling?
So I think sterling's at a dangerous crossroads, but policy credibility is at risk of being lost. In fact, it already partially is. There is a risk of, for example, fiscal dominance if the Bank of England gives up on this plan of active gilt sales because of the anticipated issuance. So what do they need to do? Hike by at least 75 or 100 basis points, signal that they may do the same thing again in the next meeting, talk about fiscal easing creating more inflation in the medium term, and persist with this active plan of gilt sales rather than hinting that this may change because of higher fiscal issuance.
Okay, George, thank you so much. George Saravelos, their head of FX strategy at Deutsche Bank, helping us walk through the news of the BOJ, of the MOF in Japan, saying that they have intervened in the FX market. Coming up, more anguish ahead. Fed hikes 75 basis points. We discuss it. This is Bloomberg. Japan intervenes in the FX market for the first time since 1998 to strengthen the yen as the yen's losses deepen. More anguish ahead. The Fed hikes 75 basis points as Jay Powell signals a recession may be the price to pay for crushing rampant prices. Up next, the Bank of England. Bailey & Co. are set to deliver another half-point increase, the first back-to-back jumbo hike in 30 years. Intervention in the FX market. That's the word from Japan's Kanda. A headline, a redhead coming through the terminal that sent the yen moving higher. It has been a whipsaw of a session for the yen. At first, the initial reaction to the BOJ holding pat on their policy was one where we first saw the yen rally. That quickly turned into yen weakness. Yet again, it is rallying. We're looking at a dollar-yen cross that's down nearly 1%. Again, Kanda saying that they have intervened in the FX market. They've taken bold actions in the market. We're just talking to George Saravelos over at Deutsche Bank, who said that this is a short-term solution to a long-term problem, more or less, that unless it's more coordinated intervention, something like G2 intervention, it's not going to move the needle. Also saying at the same time that that is extremely unlikely, that to some degree, Japan just wants to keep these moves from being too accelerated, but they can afford to let a yen weaken. Well, let's get straight to our guest for this half hour. It's Thomas Kosterg from Pictet Wealth Management, senior U.S. economist. And Thomas, I got to start here. We are looking at the yen moving in the commercial break. I mean, you said, look, it's not moving that much. To be fair, it really isn't. It's still at 143.7. To what degree is Japan and really all of these other world central banks just beholden to an ever more aggressive Fed?
Right, and yeah, I mean, the intervention so far looks a bit mellow, and especially mellow as I think the elephant in the room is the the monetary policy from Japan, which is still stuck with this yield curve control at the 10-year yield at close to zero, and I think the pressure will grow on them, especially as the Fed is still hawkish and they still intend to continue hiking interest rates. And the Japanese currency is very much driven by differentials in interest rates between Japan and the US, and those differentials are not only huge, but they're growing.
Thomas, can I make the same argument that interest rate differentials are driving a lot of what we're seeing? I mean, I'm looking at a euro, which can't sustain any strength. I'm looking at sterling, which can't sustain any strength. Even a Swissy that's selling off today, despite an S&B that's finally gotten out of negative interest rates.
Right. I mean, for the euro, it's also, I think, a function of the energy situation and the growth profile. I think, Europe is going through a severe energy crisis. The numbers we get from, many observers regarding the German GDP are not good. And we'll face a tough winter here in Europe. And I think the growth outlook is also weighing on the currency, and in Europe's case, it's not just a matter of interest rate differentials, because the European Central Bank is actually hiking interest rates quite aggressively, and will probably continue to hike interest rates. But the growth profile, and especially the energy situation, is really what's weighing on the euro right now.
Thomas, what do you think the odds are for a 1980s Plaza Accord type intervention in this market right now?
Right. So the strong dollar is definitely making things worse for the global economy. I think that we've not yet seen the full pain coming from the tighter financial conditions, from the energy crisis, but this pain will grow. And I think as the pain grows, there will be, I think, more calls to do something about the strong dollar. But I don't think we're there yet.
Okay, so we're not there yet, and we do see a continued flight to the dollar. I should say it is weaker now, given what we're seeing from the BOJ, but we're also looking at a stronger euro and a stronger sterling. But overall, the picture has been one of dollar strength, Thomas. It's been one where you get the Fed saying that they're going to get to 4.6% next year. At least that's what the dots say. But to you, does that sound like recession? Does that sound like they are engineering a recession for this U.S. economy to help get us back to 2% inflation?
Right. I think, they're going to definitely undermine demand, and undermine demand quite in a big time. I mean, the U.S. economy is super sensitive to interest rates, to the mortgage rates, to the two-year interest yield, to the high-yield bond market as well. I mean, financial market interest rates are going up quite aggressively, and what you see from economic models is that those interest rates do actually dampen consumer demand and demand at large in the economy quite in a big manner. The only thing is that there are long lags with central bank policy, and we'll only see the full effect of that by towards year end. And I think that's the risk with the Fed. I think they continue to hike interest rates because they are looking backward, and they're seeing the employment market still quite resilient. But the employment market is a lagging indicator. It's not a leading indicator. And all the leading indicators are actually weakening quite significantly. So I'm a bit worried that the Fed may overdo it, yeah.
But the question was even asked to Jay Powell yesterday, Thomas, how do you know when you've gone too far? I got to say, he didn't completely answer. He did say that they're continue to focus on inflation. So you say you're worried about it. You're worried that they go too far. How much of a probability are you placing on this idea that they do? Do you think that they're heading towards that it is very likely that the Fed just goes too far?
Right. I mean, the Fed is very backward looking. The reaction function is very simple. They look at job growth, they look at core CPI, and so far they're strong, and they're too strong in their taste. And if they continue to be strong, they continue to hike by 75 basis points. I still think they will soften in the coming weeks, so that's why I think they will modulate the rate hikes. But the problem is all the inertia of the past rate hikes that will continue to affect the economy. And I think that's where probably, what I would have highlighted to Jerome Powell probably yesterday is those long lags in monetary policy. We'll see the full effect of that, again, by December and January. And I think that's when I think the Fed could take a moment to pause and potentially stop, because the economic data could take a turn for the worse.
Okay, Thomas, thank you so much for joining us today. Thomas Kosterg, Senior U.S. Economist at Pictet Wealth Management. Let's get back to Japan, because Japan's top currency official, Masato Kondo, just confirmed that Japan has intervened in its FX market. Their remarks also follow Kuroda speaking earlier. The move in the currency has been immediate. It has been dominating the dollar move. You're now looking at a yen, which is strengthening versus the dollar more than 1%. It's picking up steam. Let's bring in Bloomberg's Paul Dobson more for this. So, Paul, again, we heard from Konda saying that they've intervened in this market. But, of course, this is not a coordinated intervention. This is something much different. What type of intervention are we likely seeing from Japan at this moment?
Yeah, well, a noisy one at least, Danny. You know, if you're going to do it like we was discussing earlier, make a splash, tell everybody that you're doing it and have the biggest bang for your buck, so to speak. You know, the Bank of Japan and the government officials are explicit in what the reasons for the intervention is. They're seeing the moves as one-sided. They're seeing the moves as speculative and too far and too fast. So this is a slap down against anything that is that aggressive, you know, and it was a profound weakening that we saw earlier in the day after the BOJ interest rate decision. So, you know, kind of like it's a one-sided move, the kind of thing that may slow things down, but is probably not going to be a kind of draw a line in the sand. That's it. We're never going beyond these levels at that point.
Fair enough. I mean, we are seeing strengthening in the yen. Again, as I say, more than 1%. It feels like it continues to pick up steam. I mean, these are traders who are concerned about intervention in the yen, or at least are very jittery to it. I mean, Paul, what do we know about positioning at this moment? Is this a market that's primed, that's expecting further intervention, or is the overwhelming opinion one of continuing to short the yen?
Well, I think you know, kind of it's one of those things like a child trying to steal the cookies out of the jar or whatever, isn't it? Where you know, the speculators want to keep on pushing the currency weaker now, but are going to come up against that opposition from the central bank if it goes too far. I think your right positioning was looking extended. You know, the speculators were in there because they scented that kind of blood, the stronger dollar, the more aggressive Fed, and that kind of thing. And so this will cause some of the late to the game people going long dollar yen to have to retrench some of those positions and cover again. So, you know, maybe it's a good move from the BOJ to flush out some of that yen short interest, to at least slow things down and make people think twice before they go all in on that as their preferred way to express dollar strength as a theme.
But, Paul, I just want to sort of emphasize perhaps the historic nature of this. We've, of course, seen Japan intervene to weaken the yen, but the last time they intervened to strengthen the yen was 1998. And we've seen some remarkable volatility today, from dollar yen up 1.8% to now down to 1.2. What do you make of how just volatile this market has been?
Yeah, volatile. Yeah, is absolutely the play, not just for the yen, but for everything across FX markets, right? Just because of that dollar strength. You know, we've seen key levels falling across the Asian markets. Seen the rupee pop straight through the 80 level, Korean won at the start of the day through that 1400 mark that they've been watching as well. You know, so it's not just the yen. It's not an isolated thing. It is a volatile FX trading environment, which is brilliant if you're an FX trader, if you're somebody who enjoys looking at this volatility, who enjoys following these trends. You know, it's been a great place. But, you know, kind of if you're a company, if you're a business that is trying to do, you know, kind of like you set your business plan for the next 6 months, 12 months, and you're seeing the markets moving around this much or moving this rapidly in one direction or the other, it makes your business planning very difficult. It makes your operating environment uncomfortable. And that's probably one of the things the BOJ is thinking about when it steps in to try to alleviate and reduce some of those price swings.
Yeah, try to get that stability back into the market. All right, Paul, thanks so much. Paul Dobson there on the immediate reaction to Japan's intervention. Now, coming up, we're going to talk to the CEO of Silicon Valley Bank UK about challenges and opportunities facing tech startups and the massive growth in venture debt. More on that next. This is Bloomberg. Yen continues to strengthen versus the dollar, with Conda from the MOF saying that they have intervened in the FX market, that they have taken decisive moves. Again, this is just unilateral intervention. It is not a coordinated one, but it has been enough to strengthen the yen. Dollar down nearly 2% versus the yen at this moment. Recall, the day started with the dollar as strong as 1.2% versus the yen. This is some remarkable volatility in the face of the first intervention to strengthen the yen since 1998. There will be a press conference. Suzuki Conda, they're going to be briefing press around 10:30 a.m. London time, so in about 45 minutes. So possibly more volatility to come in this market. All right, well, from the yen, let's turn to the overall business and lending environment. We've seen worries about a recession, rampant inflation, sparking industry-wide pain in the corporate debt market. It's caused some banks to close up shop, refraining from taking on more risk. But is venture capital funding facing the same freeze? Let's get to someone who knows this market extremely well and has been involved in its massive growth of venture debt. It's Aaron Platts, the CEO of Silicon Valley Bank UK. Aaron, thank you so much for joining. So, I mean, it has been an issue for private equity. A lot of them have struggled to get the financing because of banks. Is venture capital having the same issue?
So I think, well, firstly, thanks for having me. It's been a really interesting first 8 months of the year, coming off of record 2020 and 2021. And capital is still flowing, though definitely not at the outlier year that we saw in 2021. So looking at equity versus debt, two very different dynamics happening for fast growth, loss-making venture-backed businesses and private equity businesses. So while equity markets have tightened in the first 9 months of the year, from our perspective, we've never been busier from a lending side, whether that be helping these growth stage venture-backed businesses extend runway, working capital, acquisition finance. I think we're going to see a good amount of consolidation in this space in the next 6 to 12 months. And then private equity for these fast growth, high recurring revenue, profitable enterprise software has been hugely active as well.
I mean, the word that sticks out to me there is profitable. Sort of this idea of venture capital growth at any cost in a world where we're seeing everybody from the BOE to the S&B to the Fed raise interest rates. Is that model gone now?
I don't think it's gone. I think we're in the midst of a recalibration that's happening that in many ways isn't unhealthy. So to your point, from a macro perspective, rising interest rates, inflation, we've seen a massive challenge in public markets. That has absolutely trickled into the private markets as well, in terms of valuations, in terms of velocity and size of venture capital rounds. But innovation is pervasive, right? There's trillions of dollars sat on the sidelines from both a VC and a PE worlds that is time bound. So you've got great innovation, you've got a growing innovation economy, and lots of money sat on the sidelines. So do we need to navigate the next 12, 18 months? Absolutely. Is it harder for companies to raise? For sure. But actually, for me, the long-term outlook still is really positive.
Well, of course, Silicon Valley Bank, I mean, it's in the name. Your roots are in the U.S. Coming to the U.K., looking at this market, how does its growth compare to that of the U.S.? Because the U.S., of course, is much more mature at this point.
Yeah, for sure. And it still is, right? So I moved over from the US back in 2007 when the innovation economy was very, very different than it is today. The last 10 years, we've seen a massive increase in the breadth, depth, diversity of innovation being started and scaled here. The last 5 years have been tremendous. We've seen tons of tailwinds. In 2021, actually, the UK and European venture ecosystem raised about $118 billion. And that was the size of the US venture economy in 2018. So it's the gap is narrowing. And while the US is bigger, it's more mature, we're absolutely seeing global category leaders being started and scaled within UK and Europe. And so again, a lot to contend with from a macro perspective, but a lot to be excited about.
What has the macro perspective, the volatility there, meant for exits, meant for the IPO market when it comes to venture capital?
Yeah, I mean, to be direct, the IPO market is pretty much closed, right, for 2022. I don't necessarily see that opening anytime soon, given what's happening externally. So what that means is a lot of our companies are cautious, right? They're thinking about ways to extend runway to protect that cash position. But they're also coming back off these record years of raising capital. So they have really, really strong balance sheets. And they've got a playbook that they had to deploy in COVID around thinking about runway extension, around thinking about what levers they could pull around costs. And of course, going back to where we started, using debt, right, as to complement that equity story. So exit environment on the IPO side is going to be tough, but I do anticipate further M&A in the next 12 to 18 months as consolidation is going to be needed in the industry.
Okay, I feel like that's a nice optimistic note to end it on, Erin. Thanks so much for joining us. Erin Platts there, CEO of Silicon Valley Bank UK. Now, coming up, we're going to continue to discuss the yen. Just want to point out it continues to fall, currently down nearly 2% versus the dollar. We'll also talk about Zelensky as well, urging world leaders at the UN to keep pressure on Russia. Those stories next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. In a video address, Ukrainian President Vladimir Zelensky urged world leaders at the UN General Assembly in New York to keep up the pressure on Russia. Earlier, U.S. President Joe Biden took center stage to rally international support for Ukraine following Putin's military escalation. Let's get straight to Bloomberg's Maria Tadeo. So, Maria, we've had world leaders reacting to Putin's comments on partial mobilization. What have we heard from them?
Yes, and Danny, to some extent, what an incredible week. You have the United Nations, the General Assembly, and I know oftentimes we wonder, forums like this, do they actually serve a purpose? Do they actually improve diplomatic relationships? But this particular edition, just the moment of it, you had all of the Western leaders in the same place, at the same time, same location. And of course, the messaging from it, it's not just the visuals, but it's the tone. You did get pretty much every Western leader saying this is a mistake from Vladimir Putin. He now has decided to increase the level of brutality in this war. And of course, it means, well, this is a real drama for young men in Russia. But of course, it means de facto that the length potentially and the magnitude of the conflict could be extended in time. When it comes to the nuclear threat made by Vladimir Putin yesterday, remember that line, I'm not bluffing, I will do all means necessary to protect Russia. What you did see here is some attempt to de-escalate. Every Western leader repeating, we have a doctrine in the West, you do not play politics with nuclear, there are no winners in a nuclear conflict, you have to be rigorous, but do not engage verbally on this matter. Okay, Maria, thank you very much for the update. Bloomberg's Maria Tadeo there.
All right, let's get back to the drama that is this currency market. Japan intervening according to the MOF there. And let's get straight to Christine Aquino, who is with us. So, Christine, I mean, I had a viewer write in saying essentially currencies are trading like meme stocks at this moment. Yen strengthening versus the dollar 1%. The S&B's Governor Jordan saying that they're willing to be in the market on the Swissy if needed. The Swissy is tumbling versus the dollar. I mean, are we in panic mode when it comes to central bank credibility right now?
Well, it certainly is a bit of a scramble for central bankers to kind of retain control, especially of the currency markets. And it's something that we're definitely seeing with the Bank of Japan today, as well as the S&B. It's very interesting, though, the contrast in the market reaction that we saw, because, of course, this intervention threat from the Bank of Japan has been in the market for quite some time. That is the reason why traders have been kind of daring the Bank of Japan to step into the market, pushing dollar yen up to that 145 level, which again proves to be the line in the sand and pushing the Bank of Japan into action. Though how much bang they're getting for their buck, exactly. I wonder is the big question, right? Because we're really only a few big figures down from the peak in dollar yen at this point. We're not even below the early September levels at around 138. And so the question is how much more they're going to have to do from here. That is kind of the danger when you step into an intervention policy, is you risk turning that into a bit of a spiral.
Yeah, I mean, we were just talking to George Saravelos from Deutsche Bank about this. How much are they spending to get this done? 30 seconds here, Christine. What is the current sentiment around possible more G2, more sustained intervention?
Well, Danny, I think this does kick off a potential new era of threat of intervention, whether it's strengthening the currency or weakening the currency when it comes to the S&B. I think this will all come to a head to a point where, you know, it either needs to get the dollar strength, really, which is ultimately behind all of this, to stop, or something that needs to be done in a more coordinated way to stop it.
All right, Christine, thanks so much. That's Bloomberg's market editor, Christine Aquino, keeping us up to date on a yen that's stronger versus the dollar, 1.4%. The market moves are dramatic. We'll have them for you in the next hour as well. This is Bloomberg.
We've been here before. The Fed goes through tightening spells and easing spells and pauses.
The Fed continues to be really focused on the emerging data.
The Fed has to do a lot more to get the economy where it wants to.
Chairman Powell has got one mission, that's to deal with inflation.
And certainly in my view and in the view of the committee, there's a ways to go.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The price of crushing inflation. Fed Chair Jerome Powell signals that a recession may be necessary. It's the Bank of England's turn next in the spotlight after the Swiss announced a 75 basis point hike. Meanwhile, the Japanese government intervenes in the foreign exchange market to prop up the yen as the Bank of Japan holds firm on ultra-low rates. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, just as you thought we were done with the Asia part of the day, the Japanese government intervening in FX markets, putting FX front and center for today's session.
Yeah, making FX and Japan specifically really the only story in Asia, Anna. It was a down day for Asian equities broadly following the losses we saw in the U.S. on the back of that hawkish Federal Reserve 75 basis point rate hike yesterday. And of course, as you said, the Bank of Japan holding rates steady, maintaining yield curve control in that 25 basis point cap on the 10-year JGB yield. They're keeping policy easy, and that had the Japanese yen reaching weakness against the U.S. dollar we hadn't seen going all the way back to 1998. We breached that 145 level, and that seems to be the line in the sand for Japanese policymakers, including the BOJ, because no sooner had we digested those headlines of 145 on dollar yen than we get the news that Japan has intervened directly in the currency market to stem the losses in the Japanese yen. It is the first time they have intervened to stop weakness in the yen since 1998, the height of the Asian currency crisis. And as a result, a dramatic reversal happening in dollar yen. If you are listening on radio, basically all you need to know is it is a straight line down on the chart. The yen now stronger against the dollar by about 1.3%. We're trading now at 142.17, Matt.
Yeah, and it's such a huge move and so important to markets because so many people have Japanese yen carry trade trade or a JGB carry trade on. And this goes against that trade. Now, it wasn't entirely unexpected, but it's sure to wake a lot of people up early this morning and put a lot of stress in this market, even after we saw the stresses of a more hawkish Jerome Powell than the market expected yesterday. Take a look at futures right now. They are still up on the S&P about 1/3%. We have the 10-year also holding steady at about 353. This is, by the way, interesting because we saw the 2-year yield jump well over 4% and the inversion bump out to like 60 basis points yesterday. So be watching that closely. The Bloomberg US Dollar Index coming down on this Japanese yen intervention, though still at an incredibly elevated level of 13.19. So still holding at an almost record high, but this new move that we've seen from Japan, the first time, as Kailey pointed out, that we've seen it in almost 25 years, is putting downward pressure on the dollar. And then finally, Bitcoin, still gaining, or gaining now, I should say, as the dollar drops back to over $19,000, 177. Still, this is a currency that I think not a lot of people are going to be paying attention to today, even after Diamond's comments yesterday that crypto is a Ponzi scheme, because all eyes are really on the Japanese yen. Anna, what do you see in Europe?
Yeah, and Jamie Dimon said similar things, didn't he, Matt, in 2017? So back to the markets of today then. As you say, this is the picture in Europe, a fairly negative one, but we're still dealing with the Fed of yesterday. Seems like a long time ago now. But we saw negative stock reaction, of course, negative for risk assets from the Fed's more hawkish outlook than anticipated. And so European stocks having to price that in. Let's get to the FX markets here in Europe, because there's lots to talk about here as well. The Swiss National Bank out with a rate hike of 75 basis points. Now, that was entirely as had been expected, but we've seen weakness in the Swiss currency as a result. The SNB also said that they would be ready to act on the strength that they have seen in their currency. So they don't have the same problem as the BOJ. Directionally, but they certainly have been talking about doing something similar, at least the topic of intervention very live. And just in the last few moments, the SNB's Thomas Jordan talking about how they could act on both directions, and there's not a particular level they have in mind. But this is the movement we saw, the weakness that we saw in the Swiss franc as a result. Now, it's not the ECB that's intervening in FX markets. It's not the European governments. It's the Japanese governments that are doing it. But it's still having an impact here. Just as we saw that news around what the Japanese government is doing, and just as that strengthened the yen, it also strengthened the euro, strengthened the pound in sympathy. So the euro up by 0.4% as a result. Just to brief, there are other stories happening in Europe as well that might be of interest to those with exposure of bank-to-bank stocks in the US. This is UniCredit, the Italian bank, the CEO there, saying they're going to be able to upgrade guidance for the third quarter. And this, of course, has to do with the higher rate environments as well. That stock is higher. And Deutsche Bank, a similar message from the CFO in this case, talking about the revenues, Kailey, coming in at the top end of estimates.
All right, Anna, and we're going to have more on the banks in just a minute. First, though, let's take a look at the day ahead. We'll be getting some earnings, including from FedEx, which will report after the market close. Remember, we've already gotten a warning from them last week. We'll also be hearing from Costco, which reports its fourth quarter results. Plus, bank CEOs, including JP Morgan's Jamie Dimon and Bank of America's Brian Moynihan, will be appearing on Capitol Hill again today, this time before a Senate Banking Committee hearing. And in terms of other events to watch, U.S. data is on the agenda, including current account balance and initial jobless claims. And finally, the central bank rate decision, another one today. The Bank of England will be making its move at 7 a.m. New York time, Matt.
All right, we'll be watching all those things closely. Now, Japan's Ministry of Finance intervened in FX markets. We've been telling you to halt a slide in the yen against the dollar. That has taken the currency to its lowest level in 24 years. The slide initially, now the turnaround because of the intervention. Paul Dobson, Bloomberg Asia Markets executive editor, joins us now for more. Just explain to our viewers and our listeners, Paul, how important and how big this move is.
Yeah, it's certainly a significant development. The Bank of Japan has been keeping that interest rate locked at a low level to try to spur the inflation that the Japanese economy needs to get out of this kind of 20 years of deflation or disinflation and economic kind of funk that it's been in. But in order to do that, or while it's doing that, it's been, kind of increasing its yield gap with the US all the time that the Fed has been hiking on the other side of it. And so that has been sucking money out of Japan and towards the US, right? And so, enough is enough. The Bank of Japan had its meeting earlier today. The MOF watched the results, saw another big move. It came out, it said, look, this is speculation, this is too fast, too rapid and one-sided. They moved to quickly slap down what was going on in the currency markets. And it's significant because it's a unilateral move. It's not in accord with other central banks. It's not in accord with other monetary authorities. It's acting on its own there. And so that's why it's a big deal, important to pay attention to.
Right, and so that is important, isn't it, Paul? Because I wonder how long-lasting the impact of this intervention is going to be if there is no change in underlying Bank of Japan policy, which partly has been driving yen weakness, and if there is no coordination.
Yeah, probably not that sustainable at these levels. You would expect that if everything stays the same, then the tide is going to come back again towards a weaker yen. But what the Bank of Japan, what the Ministry of Finance can do is slow that pace of weakness, right? So it can make people cautious about taking large positions betting on a weaker yen again. It can put these little roadblocks along the way. I think the thinking is probably we don't want to draw a line in the sand because we know that the market will test that. But if we can surprise it every now and then, if we think that we're moving too far, too fast, then that can have some sort of effect at giving some sort of sense of stability in the currency markets.
All right, Bloomberg's Paul Dobson, thank you so much for your reporting on this breaking story. The Bank of Japan deciding they will still keep policy easy. They just may have to deal with the yen in other ways. One central bank, though, definitely not keeping policy easy is the Federal Reserve. Officials gave their clearest signal yet that they're willing to tolerate a recession as the trade-off for regaining control of inflation. Policymakers raised rates by 75 basis points for the third time in a row.
The median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that.
Bloomberg's Danny Berger joins us now for more. Danny, is there any possible way you could have read yesterday as dovish?
No, definitely not. I mean, maybe they didn't go 100, but even so, Kailey, they didn't have to go 100. They still were able to deliver this hawkish surprise to markets. For a radio listening audience, I have the dot plot in front of me. And by lifting where they see rates for this year next, 4.4 and 4.6%, this was essentially the equivalent of delivering an 100 basis point surprise onto the market without actually doing it. No one really saw this coming. The market wasn't pricing it in. Economists weren't pricing it in. So with that, the Fed is sending a very clear signal that they're willing to put cracks into this economy. As Jay Powell said, there's no painless way to do this at this point to bring inflation down. At the same time, unemployment is going to be 4.4%. That's their prediction for next year as well. That sure sounds like not a soft landing. These markets have responded. We're looking at a yield curve that at one point was its most inverted since the 1980s. At this moment, it's its most inverted since back in the 1990s, but still it is clear with a bond, a front-end yield that continues to move higher above 4%, a cap on long-end yields, that there really is this concern about recession being priced into the markets.
So that's the concern over in the US. US policy set largely, of course, for a domestic audience, as most policy is from central banks, but they have read across, don't they? And what the Fed is doing has an impact elsewhere in the world.
Absolutely. Look, it's what Paul was just talking about with the issues with the yen. Anna, you were talking about the S&B. It really is this conundrum for central banks that in the face of an ever-aggressive Fed, everything they do looks small in comparison. I mean, S&B ending negative interest rates for the first time in about 8 years, but still that doesn't look like enough to keep strength in the currency when you have a Fed doing what it's doing. You've seen this pressure yields, you've seen this pressure not just treasuries, but German yields, for example, the German yield curve inverting the most on record, and the last time it inverted was 2008. This is a lot of stress that global markets are under, and the Fed does not seem like it's going to be stopping that.
All right, this is really the only story in town right now. Danny, thanks so much for joining us. Meanwhile, traders are bracing for the Bank of England to deliver its 7th back-to-back rate hike later. And just more central bank news. Lizzie Burden joins us now for more. Lizzie, 50 basis points or 75. What do you think the central bank is going to do today?
Well, markets expect 75 basis points. Economists only see 50 basis points. Economists are taking account of all that weak economic data that came out of the UK last week. And the Monetary Policy Committee, of course, has had time to digest it because this meeting's been delayed because of the Queen's passing. They also look at the energy bailout from Liz Truss, the new Prime Minister, and they reckon that the short-term inflation impact is going to be softened. Markets, meanwhile, though, are looking at the international context, as you mentioned, even the Riksbank going for a full point hike. But you have to ask, is the Bank of England really going to take account of that? It was letting the Fed do 75 and while it was doing 25. Is that going to change? The other thing we're going to be watching is the flip side of the bailout. It's going to necessitate a lot of borrowing. We're expecting a load of tax cuts in the mini budget out of the UK tomorrow. And so is the Bank of England going to slam the brakes on active quantitative tightening given the borrowing coming down the pipeline? Some economists are saying no, because the Bank of England has been accused previously of monetary financing, so it's not going to want to look like it's in cahoots with the Treasury. But BNP Paribas does say they're going to hold off on active gilt sales for now.
All right, a monetary and fiscal conundrum. Bloomberg's Lizzie Burden outside the BOE, thank you so much. Meanwhile, big bank CEOs began testifying in Congress yesterday before the House Financial Services Committee. The testimony covered a range of topics, including crypto. JP Morgan CEO Jamie Dimon minced no words about his views on the matter.
I'm a major skeptic on crypto tokens, which you call currency, like Bitcoin. They are decentralized Ponzi schemes.
Kind of a buzzkill. Sonali Basak, our global finance correspondent, is joining us now for more. So, Sonali, other than going down on crypto, what else were your takeaways from yesterday, and should we just expect more of the same in the Senate today?
It's a good question. This was a committee that was dealing with stablecoin regulation, so there was not a lack of purpose to those comments about cryptocurrency, but there was a lot else at stake here. Congressmen were very concerned about China. One had even asked the bankers if they would retreat from China if China were to invade Taiwan. There were a lot of concerns about diversity. One lawmaker was also very concerned about jobs and really called out Wells Fargo in particular for conducting 9 rounds of layoffs in Iowa and the reduction of that mortgage business. We knew this. Lawmakers would be very concerned about the housing market. And there was a lot of discussion, I would say, also about the impact of more regulation and what this would mean for increasing capital requirements and the impact then on lending. I would also say, though, that there were lawmakers who did recognize that this did not only keep the banking system safe in the last decade or so, but the banks were still immensely profitable in that decade. So there was a lot of rhetoric here, but again, this is now, we've been doing this since 2019. Will it continue in the coming years? We'll see if the texture of these committees start to change post-midterms.
We got another report about Credit Suisse. Honestly, there's a whole industry covering just Credit Suisse and its woes, right? In Zurich.
Yeah.
They could resurrect the idea of a bad bank, according to the FT. What do you hear?
We've seen this done before, and remember, this is in the grand plan of Credit Suisse really trying to stave off raising more capital. Remember, their cost of borrowing is already increasing because of that really ratings issue that they're having. But there's a range of things being discussed here, a bad bank being one of them. The FT is reporting that part of what could go in that bad bank is that securitized product group that could also potentially be sold. And we have previously reported that potential buyers could be Apollo, could be BNP Paribas. So a lot of potential beneficiaries as Credit Suisse shrinks down, but a lot of options for this firm as it restructures. However, we are seeing that restructuring plan taking more shape.
Sonali, thank you very much. Bloomberg Sonali Basak with all things finance. We'll get back to the latest moves in FX markets and beyond. We will talk about the US economy and the Fed, the strong dollar and the impact of that globally. Danielle DiMartino Booth joins us, a former Fed advisor who's now CEO and chief strategist at Quill Intelligence. We will also talk FX then with Jane Foley of Rabobank. How sustained an impact can the Japanese government have? This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, we are looking at really an historic day, and I've got a chart to illustrate that. The last time we saw intervention by I guess the Japanese finance ministry, because they're the ones who do the intervention, not the BOJ, in the yen to strengthen the yen, to halt weakness, was 1998. So it's been, 24 years since we've seen this kind of action in markets. Dana El-Baltaji, Bloomberg managing editor for credit, joins us now. And I was trying to think about what links this to your world, to credit financing, Dana. And I guess probably a lot of people use the yen as a carry trade. What else do you see in this that will relate to what you're covering today?
You know, it really depends on whether or not you think this is going to have a long-term impact on the weakening currency. And I really agree with the assumption, with the assertion that this is basically a roadblock on a otherwise very hard road to weakness. I mean, I think basically what they're trying to do is that they're trying to make it kind of difficult for people to assess how weak it's going to be. But I do think that the dollar strength is kind of assumed here, and that's why they have come in. I don't know how often they will come in, but ultimately, I think the carry trade is still alive, and I do think that there will be interest in assets in this part of the world with that carry trade.
Okay, and before we were talking about the BOJ, we were still reeling from a further iteration of the Fed hawk story, and that's certainly what we saw. The impact on credit markets from that, Dana, is that something that keeps on giving?
Oh, yeah, absolutely. And the thing is that you can actually see with risk that it's going up and it's going down, and people don't know how to assess what is going to happen. When a central bank comes and says that we think that our currency is too weak, or when a government says that they were going to intervene, you basically have a sense that there might be some support in that market. However, if they come in and they support that market, that means that there is a lot of pain that is coming. So you've got these two opposing forces. Now, what we are definitely seeing is a repricing of risk. We now know that recession is probably on its way, and it's a whole new question of valuation. What is the value of the asset? How much can you pay for a specific asset? At this point, we don't know what valuations will look like.
Okay, Dana, thank you very much for that. Bloomberg's Dana El-Baltaji with the view from the credit markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you find the Markets Live blog. They're all over the FX moves today, that's for sure. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The price of crushing inflation. Fed Chair Jerome Powell signals that a recession may be necessary. It's the Bank of England's turn next in the spotlight after the Swiss announced a 75 basis point hike. Meanwhile, the Japanese government has intervened in the foreign exchange market to try to prop up the yen as the Bank of Japan holds firm on its ultra-low rates. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, what with the focus on the Fed and what the Japanese are doing with their currency, what the SNB are doing on rates, I've totally taken my eye off stocks.
And
it's
the
all
Bank
been about
of England
FX
is coming out later. I mean, you got to have your head on a swivel.
Absolutely.
Yeah,
you
it's
need a number of
insane.
heads today. So tell me what's going on pre-market.
I was thinking the same thing. We're looking at futures right now that are just up 0.2%, but who has time to even look? With all of the news coming out and things that we haven't seen since the 90s, things that we haven't seen in terms of the 2s, 10s since the 80s. And there's so much to focus on this morning. Right now, S&P futures at 38.14, the 10-year yield at 3.53. Maybe more interesting is to look at the 2-year yield. It's up over 4%, and the spread is out to 60 basis points now to the downside. The dollar index right now at 13.19, almost 13.20, so hovering at a record high. On the other hand, it's getting some pressure on it because the finance ministry in Japan is intervening in the dollar yen. So very interesting stuff, kind of working at cross purposes with the Bank of Japan, which refuses to raise rates for like 2 or 3 years. Talk about forward guidance, but Kailey will get to that in a moment. And then Bitcoin. Right now, it's even hard to think about something as small as Bitcoin compared to moves as large as global FX, but it is a currency that a lot of people pay attention to, up over $19,000 right now. And it's been in the news, right, because Jamie Dimon yesterday said in front of Congress that crypto is a giant Ponzi scheme. Kailey?
All right, well, you promised it, so I'm going to deliver more on the Japanese yen right now. Because as you said, Matt, the Bank of Japan had a decision overnight. They decided to not do anything, to maintain their easy policy, ultra-low rates, continue yield curve control, all things which contribute to weakness in the currency, which is why we saw the Japanese yen breaking above that very closely watched 145 level to the U.S. dollar. That is weakness we hadn't seen going all the way back to 1998. And as a result, we see intervention of the kind we have not seen since 1998, the height of the Asian currency crisis, with Japanese officials intervening directly in the currency markets to support the yen and stem its weakness, which is why we saw after a weaker Japanese yen to start the day off the back of that BOJ decision, it is now a decisively stronger Japanese yen, a straight leg lower on an intraday chart right now. The yen stronger against the dollar by 1.25%, trading right now at 142.26, Anna.
And Kailey, that decision by Japanese officials, by the Japanese government to intervene in FX markets, having an impact even here in Europe. We'll get to that in just a moment. This is the big picture on European stocks, though. A day after the Fed, getting the first chance to factor in what the Fed said and that level of hawkishness and the height of the dots that we saw for next year. And we see stocks selling off as a result, down by 0.7%. Not all sectors negative at this stage, 2.5 hours into the European trading day, but most of them are. And the story is weaker for risk assets. Interesting to watch what's been happening at the SNB. The Swiss National Bank increasing interest rates by 75 basis points. We used to call that jumbo. We seem to be redefining jumbo hikes as every week passes for global central banks. But that's what they did. That was as expected. But the currency fell. This is the euro gaining against the Swiss franc because they also talked about their ability and their willingness to intervene in FX markets if they want to. And of course, they've seen strength in their currency of late. This is the pound against the dollar. And really, it was the Japanese authorities intervening, of course, in what's going on in FX markets. But that did have an impact here. So just as we saw the yen gaining, we also saw the euro gain and we saw the pound gain. So it's as if the strength in the dollar around the world was for a moment being questioned. And we see the pound hanging on to those gains back above 113.09. And it is Bank of England day. We'll keep an eye on that later on. And UniCredit up by 5.7% for the Italian bank. The CEO of this business suggesting there could be an upgrade to come to their guidance for what they can achieve in the third quarter. The rising rate environment clearly better for the banking sector. And that is one of the best performing sectors today here in Europe, Matt.
It's so interesting to hear that the pound is holding on to gains at 113,
yeah.
right?
Because lofty levels of 113.
Yeah. Joining us now to talk about all of this and what we heard from Jay Powell. Don't forget, the Fed was just yesterday, is Danielle DiMartino-Booth. She's a former Fed advisor. She's now the CEO and chief strategist at Quill Intelligence out of the Big D, Dallas, Texas. She joins us, though, in the studio here in New York. Danielle, great to have you on set. Tell us first about why we're seeing this kind of action in Japan. In the makeup room, you said to me, the Fed has the Japanese and the Europeans behaving like emerging market economies, which is crazy.
It's what it appears to be. I mean, that's what we're behaving like, right? The IMF has bailed out everybody else. So what are we going to focus on? But that is the nature of currency wars gone wild against a backdrop of central banks competing with one another. We might see 75 basis points out of the Bank of England with unusually large rate hikes when all other countries, if they're manufacturing, if they're exporting, they want to remain competitive. But this is like the big stuff, though. I mean, we're talking, you're saying we're going back to the 90s, we're going back to the 80s. This is like the Breakfast Club soundtrack in my head here. But it is
Simple minds.
Yeah, well, yeah. But this is, it really is crazy. But when you think about how resolute he was yesterday, it's like, you know, the U.S. economy is going to expand at 0.2%. That's how we're going to start this press conference. By the way, we're telling you that we're going to tighten into a recession. We're letting you know.
Well, basically no longer being shy about the fact that the cost of fighting inflation is pain in the economy. Right. And yet when our own Michael McKee asked him, how are you going to know if you've done too much, if you've gone too far with that? He gave a non-answer. I mean, realistically, is the reality we're looking at here, the Fed is going to go too far because it won't know in advance that it is.
I think that the Fed has already told us that it's going too far. If you look back to every rate tightening cycle since 1980, the Fed is tightening at 3 times the pace. This all just started in March. We said it just a few days ago.
It's wild.
And we've already seen as much as we have. And he reiterated in the press conference over and over and over again, we might consider pausing as soon as we get to 5. I mean, and that's where he's going. He's getting to the end result, and he's not stopping until he gets there. And he really doesn't want to have anybody ask him about it.
He doesn't want to, but they will keep asking, won't they, Danielle? Good morning to you. Let me ask you then about the strength in the dollar and how that goes down with the Fed, how that goes down in the U.S. economy, because clearly we see policymakers globally objecting and taking action. We're just looking at some lines coming through from a press conference being held by the Japanese finance minister, having to talk about what actions they've been taking against what they see as excessive moves in FX markets. But how does the strength in the dollar play for the Fed?
You know, it was interesting because the only time I felt that he was nuanced during the press conference yesterday was when he asked about how Fed policy was going to affect other countries around the world. You're not making policy on an island. And he basically said, well, there's no perfect formula here. He was saying, we're sorry in advance, but we're going to keep on going. But it was
we hung out in Basel. We talk on the phone occasionally, but we're not working in concert.
And that's so unusual because we've come through a period in which, in the post-QE era, central banking has been globalized and coordinated. This is not, you don't run off like a cowboy into the West doing what he's doing, and yet nothing appears to be stopping this man. And I speak about him as an individual, even though yesterday he said, we, dot plot, we're all in concert here. We might as well be all be Jim Bullard. Everything's going to be unusually large, but he was clearly speaking for himself.
You brought up an interesting, I'm going to call it a conspiracy theory yesterday with me and Paul Sweeney on radio, saying that it's not just about inflation here. Jerome Powell has an ulterior motive. What do you think that is?
I think he does. I think he's tired of the tail wagging the dog. I think that he wants for the Federal Reserve to make monetary policy, not for markets to make monetary policy. If that's going to be the dynamic, if he's going to actually bring back independence to the institution, he's going to have to break the Fed put. And that means he's going to have to really create a lot of destruction in the financial markets, which we've already seen. I mean, think about where the S&P is right now, going into what he's already telling us is going to be carried through 2023. It's not inflation. He's already seeing signs of disinflation in discretionary goods. We've all seen signs of housing turning. He knows that a year from now we're not going to be so crazy worried about inflation, and yet he's going to keep going. And that, to me, means he wants to break the market psyche of the Fed's always going to have your back.
Well, and the market seems like maybe it finally got the message, although it really couldn't decide yesterday for several hours in the wake of that decision.
That was existential. Watching go back and forth.
I couldn't take my eyes off the chart. One more central bank coming this morning, the Bank of England. As you said, they could very well hike 75 basis points. There's the monetary question in the UK and the fiscal one. Ultimately, is supportive fiscal policy from the new prime minister going to be more disinflationary or inflationary? Because if people are spending less on energy, they have more to spend on other things.
Well, I think that that's what we've seen here in the United States, right? We've seen that whenever consumers are given a little bit of latitude, that they'll take that latitude and put it somewhere else in discretionary goods, in things that are not essentials. And so we're going to have to wait and see. I think it's hard for Americans to couch what's going on in Europe because we have no concept of what they're spending to cover their energy needs.
Danielle, thank you very much. Danielle DiMartino-Booth of Quill Intelligence. Yes, the extent of the rise in energy prices certainly keenly felt here in this economy and over the channel in the Eurozone as well. We will talk about FX, though. Back to the FX lines. We're seeing plenty coming through from the Japanese finance minister this hour, talking about what they've been doing in FX markets, intervening to support the Japanese currency. We'll talk to Jane Foley, head of FX strategy at Rabobank, get her perspective on how sustainable these moves in the yen are. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Ellevest CEO and co-founder Sally Krawcheck. That's at 4:30 p.m. New York time, 9:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. The story today is in Japan. The yen is stronger after the country intervened in the foreign exchange market for the first time to intervene for weakness since 1998. Jane Foley, head of FX strategy at Rabobank, joins us now for more. Jane, we've been talking about it for some time now as the yen hits weaker and weaker levels. When are they going to step in? They now have. It seems it's working today. Is it going to stick?
I don't think so. I mean, if we look at the history of intervention, and of course we have to go back quite a long way if we think about that in terms of the G7, but if we think about the history, well, what we know is that intervention only works if we can really say confidently with hindsight that, yeah, you know what, the fundamentals were pulling in the same direction. And yet look at the fundamentals that we have for dollar yen. Even this morning, we had the Bank of Japan policy, the Bank of Japan reiterating, sticking to its guns about its really loose monetary policy conditions, and that was just hours after the Federal Reserve came out with a very hawkish policy response. So we know that the fundamentals will still be dragging dollar yen higher. I think what today's intervention was all about was just perhaps slowing the movement, just putting a little bit more moderation in that move. But I do think that dollar yen is still likely to be pushed higher as long as we've got the Bank of Japan and the Fed on these opposing policy courses.
Yeah, one of our colleagues writing that perhaps the aim here is just to make it more expensive to bet against the Japanese currency and to reintroduce a bit more two-way risk into that trade because it had been so crowded in one direction, Jane. In terms of intervention, though, some people are saying, well, agreeing with you that maybe this doesn't have a long-term impact because it moves counter to what the BOJ is doing elsewhere, but also because it doesn't necessarily have international support. If it had coordination, it would be different. And so interesting to see the ECB saying it didn't intervene in Forex markets. How do we interpret what we're hearing from other central banks not playing in this particular attempt?
It is very political. When you're talking about the G7 and intervention, it's political, and you have to wonder why it's been so long since the Bank of Japan intervened. Now, it did intervene in 2011, and that was with the blessing really of the other G7 central banks, but that was after the nuclear disaster. There was a human issue there, and that's why. So if we take that one out of the equation, we do have to go back to 1998 perhaps till we see a similar position. And meanwhile, in all of that time, there's been a series of G7 communiques when they really have effectively signed a communique to say that markets should be setting exchange rate, not central banks or the Ministry of Finance in this instance. And so it does go against the grain of what perhaps they've signed up for. And we haven't had, a sign-off, obviously, from other central banks, at least not yet. And you do wonder if the Ministry of Finance can keep on intervening unless there is some sort of nod that other authorities think that this is possible. Now, they could use perhaps some of the wording in the 2017 G7 communique, which says that excess volatility is untoward. It's not desirable, and perhaps that is their excuse. Gives them a little bit of a reason as to why they went today. But on the assumption that it hasn't been signed off by other G7 treasuries, then yeah, this is something which could be quite limited in its nature. Could be quite difficult for the Ministry of Finance to really sign off on.
Jane, I was thinking when I first saw these headlines about the yen carry trade, and I don't really know how prevalent it is. A trader writes in and asks, with major currencies trading like meme stocks, will markets start worrying about the risk of hedge fund blowups? Is it a hugely prevalent trade? Is this likely to affect market participants in a major way?
You know what, if you were doing something like just shorting the yen and buying the US dollar this year, you would have made an awful lot of money. If you were buying the Mexican peso, you would have made an awful lot of money by shorting the yen. So there have been, quite a big carry trade. And perhaps this is what the Ministry of Finance is trying to break. Like Anna said, just make it more expensive to short the yen, to try and throw this upward trajectory that dollar yen has been on, throw it off course a bit, add a little bit of two-way, slow down the move. Now, I think that's all that they can achieve, slowing down the move. But certainly, over the last week or so, there have been reports that the Ministry of Finance has been checking prices. That has added, some anxiety into the market. Traders a little bit nervous about that. But of course, verbal intervention and checking prices is good. It can certainly make the market anxious. It certainly has brought dollar yen lower. But that loses its credibility unless it's followed up really with action, and that's what we've seen today. So perhaps going on for the next few weeks, the next few months, we'll have more verbal intervention, more checking of prices to keep the market on its toes, to keep the market nervous. But I don't think that they are going to be able to perhaps stop the uptrend. They're just going to be able to slow it.
Right. Sorry, Matt.
Sorry, we got to go. I mean, I have a million other questions, but I'll just call
He's
Jane
just so
after the
carried
show.
away by this topic, Jane. It is very exciting. The finance minister in Japan saying they have sought understanding from other nations on FX. So we'll see what other nations have to say about this. Jane, thank you so much for your time. Really good to get your explanation. Jane Foley joining us there from Rabobank. Coming up on this programme, we'll be back to thinking about geopolitical tensions. President Biden slams Russia's actions in Ukraine. We'll discuss the latest on the war with Edward Stringer, retired Royal Air Force Air Marshal. Get his perspective. This is Bloomberg.
This world should see these outrageous acts for what they are. Putin claims he had to act because Russia was threatened. But no one threatened Russia. And no one other than Russia sought conflict.
President Biden speaking at the United Nations General Assembly this week, aiming to rally international support for Ukraine. His comments came after Vladimir Putin mobilized army reserves and renewed his nuclear threats. We're joined now, I'm pleased to say, by Edward Stringer, retired Royal Air Force Air Marshal and a senior fellow at Policy Exchange. Edward, thank you so much for joining us. 300,000 reservists. What difference can that make to the difficulties Russia is having in this conflict at this point?
I think if we're honest, it's only going to add to them. I think 300,000 people is 1.5 times as many as Putin thrust across the border in Ukraine at the start of this war. We've seen the Russian armed forces lack capacity. They're running out of weaponry at the moment. Just imagine the logistic challenge of even trying to clothe 300,000 new troops, let alone train them, let alone get them up to any form of operational readiness. So I think we'll see, as has happened before when Putin tried this, that this sounds good up front, but it's going to be very difficult to achieve in practice.
Well, it takes a long time, and it underlines the chronic problem of this Russian war in the Ukraine. The more acute concern is the anything it takes line, and he's not bluffing. Are there layers between Vladimir Putin and the possibility of a nuclear strike? I mean, I would hope that there are layers even between the U.S. president and the possibility of a nuclear strike. What kind of fail-safes are in place, or can he just push a button and do it?
No, in none of the nuclear states have got systems where you can just push a button. We haven't seen in the intelligence that there's been much movement of his nuclear forces to put them up to higher readiness, whatever he said at the start. Because you remember he made 3 overt mentions of nuclear weapons at the start of this conflict. So there are layers. It has to go down through a command chain. There are several military officers that have to do their part. So yeah, there's a nuclear firing chain. It's not just a red button on his desk.
Okay, so there's layers in between, but do you think it's ultimately going to come to needing all of those things to take shape? I mean, how real is the threat of nuclear weapons, even if they're tactical, being used in this war when it seems like Vladimir Putin is running out of options?
I think the White House is playing this pretty sensibly at the moment because one doesn't want to dismiss it and say this is pure bluff, but nor do you want to be shrill and start talking it up because that actually will be playing into Putin's information operations. So it's unlikely, but if there's any possibility, it has to be taken seriously and therefore it has to be managed appropriately. The various military planners, chiefly American, but NATO will be involved, will already have been looking at options. And so when Biden says there will be a massive response to anybody breaking the nuclear taboo, he is not bluffing. It would be such a response.
What kind of ambiguity do you think NATO needs to put between itself and what Ukrainian forces are doing on the ground? Clearly, there's a supply mission in place, money and weaponry is being sent, but what kind of lines need to be drawn?
I think the red lines have been drawn well and maintained. And that's why there was no no-fly zone at the start of this operation, because we are not going to hand the propaganda victory and cause us bell-eyed to Putin that NATO is attacking Russian forces. And so you won't see direct involvement of NATO troops unless, as we just discussed, something catastrophic in the nuclear domain happens. But what is vital to Ukraine is you continue to maintain the financial, political and military logistics support. And that's perfectly fine under Article 51 United Nations. All nations have a right to self-defense and can draw on what support they can get. Those red lines have been scrupulously maintained, and you can see it even today as Biden mulls over whether he's going to supply the longer-range ATACMS system, for example. I think that's been well maintained at the moment, but we must.
Edward, thank you very much for your time. Yeah, thanks for your contribution. Really good to speak to you. Edward Stringer, retired Royal Air Force Air Marshal and a senior fellow now at Policy Exchange. That is it for Early Edition. Surveillance is ahead with Tom, John and Lisa. They will be all over the latest movement at the Japanese Finance Ministry, the Ministry of Finance. They're intervening in the FX markets, not happy with the weakness in the Japanese currency. They have a full lineup of guests to think about that and tighter Fed policy. This is Bloomberg.